Hi, we are doing the leverage buyout for Home Depot Supply. My name is Arman, and we have Christian and Julie here as well.
The home improvement industry tends to be positively correlated with the housing market. From 2005 through 2008, the annual sales of existing single-family homes in the United States fell by 30%, while their average price dropped about 26%, and new construction of such homes also declined by 64%. HD Supply started as maintenance warehouse in 1974 and later was acquired by Home Depot in 1997. With revenues of more than $7 billion as of January 2016, HD Supply is a leading player in the highly fragmented $400 billion North American industrial and construction distribution industry. It is the second largest distributor of construction, industrial, and maintenance supplies, with leadership positions in several of the 12 industry verticals in which the company competes. Due to the fall in housing market, HD Supply sales were decreasing along with their EBITDA, and Home Depot could no longer efficiently manage all of their departments, acquisitions, and still focus on their core business. It was difficult for Home Depot to run a collection of businesses that they had acquired over the past decade, but knew that HD Supply was a great investment with great assets and would pay off in time. Home Depot team agreed to sell HD Supply to a consortium of private equity investors, Bain Capital, Carlyle Group, Clayton, Dubilier, and Rice on August 30th, 2007, for $8.5 billion and agreed that Home Depot would retain 12.5% stake in Home Depot Supply for $325 million, but expects a net profit of $8.3 billion from the sale. With the proceeds from the sale, they plan on repurchasing shares and shifting the profits to their current shareholders. Bain Capital is a multi-asset alternative investment holding company with more than $75 billion in asset under management. Through its subsidiaries, it engages in private equity, public equity, fixed income, and credit and venture capital investments across multiple industries and nations. Within their private equity activities, they specialize in leveraged buyout and growth capital in a variety of industries. Private equity funds is also their source for capital, with the most common pools being pension funds, insurance companies, endowments, fund of funds, and other institutional investors. Carlyle Group is a global alternative asset manager with $169 billion of assets under management. They specialize in private equity, which includes buyouts and growth capital, real assets dealing with real estate, market strategies, distress and corporate opportunities, corporate mezzanine, and energy mezzanine hedge funds and structured credit. Clayton, Dubilier, and Rice is one of the oldest private equity investment firms that help other companies improve their financial and operational performance. They focus on operational enhancement, which accounts for 80% of the total value created. They measure corporate performance and implement their new strategies and operational segments that result in EBITDA growth.
Home Depot began seeking a bid for its commercial arm Home Depot Supply in March of 2007. Two bids were initially proposed, one from the consortium of Bain Capital, Clayton, Dubilier, and Rice, and the Carlyle Group, and the second from Thomas H. Lee Partners and CCMP Capital Advisors. Both had an initial bid of approximately $10 billion. However, Bain Capital, Clayton, Dubilier, and Rice, and the Carlyle Group won the bid to acquire the segment from Home Depot due to particular experience with distribution and wholesale companies. Home Depot Supply began as maintenance warehouse in 1975 before it was purchased by Home Depot in 1997. Even after several follow-on acquisitions that grew Home Depot Supply's network, its parent company, Home Depot, decided to focus more on its retail business, which would require divestiture of Home Depot Supply. After being taken private, Home Depot Supply resurfaced to the public markets through an IPO in June of 2013. Sources of funds from the 2007 acquisition by the private equity consortium equaled approximately 2 parts debt to 1 part equity. Debt consisted of a combination of secured loans and high-yield bonds. The loans were made up of an asset-backed revolver and a cash flow revolver totaling $1 billion, but with potential availability of $2.4 billion, and with an interest rate of LIBOR plus 1.5%. The high-yield bonds consisted of senior notes and subordinated PIK notes, which made up an additional $3.8 billion. Home Depot also supplied an additional $1 billion in a senior secured term loan, making the total debt load $5.8 billion. The company had the availability of an additional $1.4 billion on its revolver that was yet to be drawn. The remaining capital used to fund the $8.5 billion acquisition consisted of equity financing of approximately $758 million from each of the three private equity firms that made up the consortium and $325 million from the former parent company Home Depot. This made total equity contribution $2.6 billion. The primary uses of funds consisted of purchasing the entire equity of the company and paying cash proceeds to Home Depot. Using the excess cash from the LBO, Home Depot repurchased $289 million in share repurchases at $37 per share and totaling $10.8 billion in expenditures. This was all part of a 2002 goal to repurchase $22.5 billion in shares, of which 12.8 still remain as of 2008. In addition, the company used the proceeds as well as cash flow from operations to pay dividends as well as reinvestment into the retail segment of the company through capital expenditures. The private equity consortium made an additional offer of $10.3 billion, with $1.9 billion in equity and the remaining $8.4 to be funded through debt. With Home Depot Supply's 2007 EBITDA being $994 million, this acquisition resulted in a 10.4 EBITDA multiple. However, due to a lower availability of credit as a result of the beginning of the financial crisis and the increased risk of higher debt due to default, the deal had to be revised to decrease the debt load and increase equity. The new proposal consisted of $2.3 billion in equity from the PE consortium, with an additional $325 equity contribution from Home Depot and $5.8 billion in debt. This would bring the total transaction value to $8.4 billion. However, with the addition of a $100 million transaction fee expense, the purchase price totaled $8.5 billion with a 2007 EBITDA multiple of 8.6 times. This represented an 18% discount to the original offer. Home Depot still proceeded with the transaction because they felt that they needed to focus more on their retail arm and continue their share repurchase program. The $4.8 billion in debt was provided through JP Morgan, Lehman Brothers, and Merrill Lynch. In addition, Home Depot was required to post a $1 billion secured term loan through their divested company, Home Depot Supply, raising the total debt to $5.8 billion. A portion of third-party debt was backed by particular assets, while others were backed by bridge loans. This high amount of leverage remained on Home Depot Supply's balance sheet for years to come.
As a result of very high leverage, Home Depot Supply filed for an IPO in 2013 and issued approximately 30% of their company on the New York Stock Exchange. This reduced PE ownership to approximately 60% and Home Depot's ownership to 8.5%. In 2013, Home Depot Supply reported $8 billion in revenue, which was up 14% since the prior year, and $683 million in EBITDA, up 34% from the prior year. Although the company reported strong growth as a result of private equity ownership, Home Depot Supply continued to be highly levered with approximately $9 billion in total debt, making an EBITDA multiple of 18.1. The company was hoping for an IPO price of between $22 and $24, which would have raised approximately $1.2 to $1.3 billion. However, it opened trading around $18 per share, which only went on to raise $1 billion. The IPO was meant to reduce the debt load, and the proceeds of $957 million were used to repay previous loans. With this valuation, the company's enterprise value fell to $9.9 billion. The PE firms have all since exited their investment in subsequent years after the IPO. With the closing of the LBO transaction deal, the newly managed company entered a consulting agreement where they agreed to pay the equity sponsors an annual management fee of $4.5 million, or what they called a sponsor management fee, and agreed to pay this fee through August 2017. When the company was set to go public, it paid an additional fee for an undisclosed amount to terminate this contract. Another interesting aspect of this transaction was the Home Depot Supply loan was the first major LBO financing that did not rely on the institutional loan market. Since going public in mid-2013 at initial offer price of $18, the stock performed exceptionally well up until mid-2015, where the stock experienced a major drawdown. It has since recovered and is trading near its all-time high of $41.29. On February 3rd, 2013, several months before the IPO, the remaining invested capital in the company was roughly $1 billion. The proceeds from the IPO resulted in the equity sponsors nearly breaking even at the time while still remaining 70% equity in the company. While all the private equity firms ended up making a bit of money on the deal, it was over the course of 7 to 8 years. The large investments these firms made ended up not being a very profitable one. However, considering they held their positions in a company that is directly correlated to the construction of homes through one of the largest housing market crashes in history, and were still able to return some profit, is somewhat short of amazing.